Hello, hello. Cool. Hi. Thank you for coming. Hope you can hear me well. Cool, man. Cool. How you doing, Hassi? Sorry, I don't know how to pronounce your name. Is it Hassi?
No problem. It's Haji.
Haji. Sorry, man. Sorry.
Yeah.
Thanks
No,
for
no,
that.
no. No problem. Doing fine. Good, good. Excited this
Cool,
market bull.
man. Yeah, nice to see you. This is not a topic that I was going to talk about today, but I'll just kind of just for chatter. I feel like too many people misunderstand the stock market, and that's a bold statement, but nothing goes up in a straight line, like it's just like life. I don't know. Do you ever work out? Do you ever go to the
Yes.
gym?
Yeah. Yeah.
Man, there are times where I'm swinging those weights, man, I'm killing it. I'm like killing it. And there are other
Yeah.
times that I come in with the right mindset and it just doesn't work out for me. It's like life, right? Nothing goes in a straight line. And the same with investing, people kind of feel, oh, this is like the whatever is the next Tesla, whatever. And maybe it is, maybe it isn't, but along the way, it's brutal, you know? And
Like,
I remember someone, I don't know if it was 2012 or 2013, about that time, someone said, which actually is still funny today, but someone said to me, oh, the Tesla stock is dependent on Elon, and when Elon gets a cold, Tesla's stock dies. And it was like that. It was completely brutal. It was really brutal for like a long period. It was like so brutal. And obviously, in hindsight, that was like the Tesla, right? But
mhm.
man, investing is brutal. We kind of want to extrapolate what's happening right now. Like right now, as you
Mhm.
know, like it just,
Yep.
it's a really strong market. And people feel like, oh, this is it. Like this is like the next bull market or whatever. Man, like just right, just don't overthink these things, like it, and also I get really anxious going into earnings season when
Mhm.
the market is particularly bullish, because people have these high expectations. People want to get excited, and then they just set themselves up for failure. Um,
Yeah.
yeah, it's just
Yeah. That's actually one of my question for you in
yeah,
terms of psychology, because
yeah,
like within July, August timeframe,
yeah,
I remember those conversation back then. And within last six in a row, maybe like S&P 500 is climbing up, and then DVR is also climbing up, and I made good profit over there, and
hmm
I understand the value of the diversification.
hmm
But honestly, I have a fear like election is coming up, and earnings are coming up. We don't know. All right, like the banks have done great
hmm
profit so far, like with their earnings, but there's somewhere in here I have a fear like this.
hmm
As you said, it's life. It's not going to go up. I mean,
hmm
we're going to lose probably some of our profits, but in terms of psychology, how should we get ready for those, or what should we expect?
yeah,
Like, I
that's a
mean,
really good
in a worst
question.
case, in a bad case.
Yeah, so that's a really good question. The first thing I would say is that I actually highlighted this, that in August, when things were not going well and I was underperforming, I made it clear so that everyone knew, and I posted that up. You can look it up. The article was called Back to the Wall. I wanted to be, nowhere to hide. I said to people, listen, I am underperforming, and everyone can see the article. It's 30th of August, Back to the Wall. And I said, I am underperforming. I am not happy with the performance, and I will do whatever it takes to outperform in 2024. Now, it was brutal, but I've always wanted to be fully transparent with people because I want to build trust. For me, the most important thing, I'm in the business of selling subscriptions, right? So my key priority is that the people that subscribe to me, that they trust me. And it's difficult to build trust because there's a lot of competitors out there. So it's difficult to gain that trust. But I feel that, I can gain people's trust the most by walking them through when things are bad. Everyone can sing and dance when things are good. And I said, like, when things are bad, this is how it is. And incidentally, like right now we're doing well. We're up 40%, slightly more than that, 40%. And I said, when I actually thought myself, when I get to 50% up, I will actually increase my prices. Because I feel like at that point, yeah, I did what I set out to do. Not for the people like you that are already paying, but for people, new people. The second thing you said was about, oh, there's the elections and there's this and there's that. And this is a common mistake when people are kind of investing. They like to look at a lot of different things to make a judgment. And what I refer to this as noise, and I try and pull that back. And it's really easy in the market to look for lots of different data points. The banks are saying this, and then CNBC is saying that, and it's really, really easy to overcomplicate. Oh, if Trump comes in, then there's tariffs. Like, let me just say a couple of things. First, there will be an election, and then there's going to be another president, and another president, and another president, and the world goes on. Number one, that's really, really important. There's always tomorrow, number one. Number two, we've already been through Trump. And, if he gets elected again, like it's just another president coming in. Okay, so that's the other thing. Yet another thing is that is really important is to figure out, to have a little bit of diversification. I don't believe you need 30 companies, but trust me, that having less than 10 is brutal. And within that kind of middle range of around 15 companies, it's really important to have some diversification. And by that, I mean, for example, for the sake of our discussion, let's say, oh, AI is going to be the next big winner. Okay, right, that's possible, but you will need time to recognize the ultimate winner in this. It could be perhaps saying something like Palantir that everyone is betting on right now. Or it could be something that is not even listed right now. So it's difficult, and you need to kind of pull that back a little bit. And Warren Buffett, I think it was in 2022. Let me just read this through now. Yeah, 2022, he opened up the shareholder meeting and said, oh, these are lists of automotive companies from 1920. And there was like, I don't know, I don't want to lie, but there was like 50 of them. And he said, only 2 of them are around today. And of those 2, one has already been bankrupt, and the other one is the only survivor. So when there is like a bull market in something, loads of companies come up. But to know the actual winner at the end is really, really difficult. And that's a tricky game to play, And in my experience, there's a few investors that I know by name, billionaires that have succeeded in that. But that's a really difficult game to play. A much easier game to play, which I think makes sense, is seeing which company is already halfway to winning and just buying it when sentiment is not really appreciating the potential. So I'll give a practical example. Chris, I'll talk to you about stock-based compensation. There's a question about stock-based compensation. I'll come to that. Thanks for joining, Chris. I spoke today about Robinhood. So, like, this is a company that I feel has quite a lot of potential over the next 12 months, particularly because the comparables are really easy, like from basically starting Q3 for the next 12 months, because the revenue growth rates this time last year were quite subdued. So you have a really easy comparables. So naturally, the business is going to grow quite aggressively. So that is, in my opinion, quite an easy way to play this type of thing, where you back in. Well, everyone wants to back high quality businesses that make a lot of free cash flow. Generally, this means you're going to go for like the Mag 7, but you can take that playbook and buy similar type of ideas like disruptive companies like Robinhood that, are still not being fully recognized by investors as being a long-term winner. So just to answer your question about the election, and there's a lot of noise, there's a lot of noise. I remember a few times people say, oh, look at the seasonals, like this month typically does quite badly and this and that. anytime that I've heard this story about seasonals, that happens to be the one time that that seasonal doesn't work out. It's really, really difficult to play that game. An easier game is one where you don't put so much pressure on yourself and yes, you do take your foot off the pedal slightly, but it allows you to get to your destination. And this is what something that is, I feel, so underappreciated by investors. They kind of want to make money quickly. And I find that people that come to the market trying to make money often end up losing more than they make. And if you come to the market with respect and humility and say, okay, I've got, let's say, $1,000 and I'm working to preserve that $1,000 because I've worked X number of hours for that $1,000, that investor will do a lot better because they value the time. They say, okay, I had to put this amount of blood, sweat, tears. I got all kinds of demands on my life, my family, whatever, and I had to grind through that to make this small amount of money. That money is worth this amount of hours. So if that investor, I feel, has the right assessment of the market, because every single investment is a risk reward, right? Every single investment that a person makes, there's a kind of a risk reward. There's never a bet, a risk-free investment. Okay, I kind of digressed slightly there. I'll just kind of jump into Chris's question. So Chris asked about stock-based compensation. And this is a question that comes up frequently, like how high is a stock-based compensation? What is a reasonable amount for stock-based compensation? And I have a bit of a silly answer to this. And the silly answer is that the difference between being an accountant and the investor is that the accountant is precise and wrong, and the investor is vaguely right. So there's not a hard number. I've seen a lot of people that kind of go through and say, oh, if it's 6% or less of the total revenues, therefore the dilution is kind of minimal, it's going to work out really well. Complete nonsense. When the business is in a rapid growth mode, so I'm specifically discussing here growth businesses. Obviously, if you go to the other side of the spectrum, something like PayPal, that stock-based compensation as a proportion of revenues is substantially lower than a business is growing really fast. Because when it's growing really, really fast, the majority of the investment that the business is making is on the employee stock-based compensation. So it has a very high level of stock-based compensation. It can be really stupid numbers. And the best example that I can provide that I recently sold was Palantir. That has excessive amount of stock-based compensation. And in fact, when I was picking a stock at $10, that was one of the arguments. Oh, it has so much stock-based compensation, it's a complete junk. And now that the share price, I sold it at 28. But now that the share price is above 40, people are like, oh no, don't worry about the stock-based compensation. So it just reinforces that what the market wants is to know that the amount of stock-based compensation that the business is investing, it's really an investment, right? The amount that it's investing, it's being rewarded with a certain amount of growth, okay? Now, this might be a more useful metric to think about, okay? So if a business is, let's say, growing at 30% or more, that could be described as hypergrowth. A hypergrowth business, a lot can be forgiven. You know, profitable, that's fine. I'm not going to care about that. It's really expensive to stock, that's fine. I'm not going to care about that. Provided that the market can believe that those growth rates of 30% are sustainable, are recurring, and are not going to create a lot of surprises, okay? Then you come down slightly, and you have something that's growing at what's called premium growth, like 20%. And that investors start to be slightly more concerned about the free cash flow and the proportional stock-based compensation, okay? But these are just general assessments. In the market, people like to overthink, and I have often experienced that developers still tend to get quite analytical and get kind of caught up on these things, and they kind of miss like the general idea. It's much better to be vaguely right and kind of understand, okay, that the business is going to have some staying power rather than get caught up on that line of the income of the cash flow statement. A good example is PayPal. When I was recommending PayPal, people are like, oh, it has this amount of debt and it has this amount of interest, therefore it pays this much tax and it's never going to be like, and I'm like, well, slow down. Like, you have to think about, if you're paying, hypothetically speaking, about 10 times EBITDA and the business has minimal growth for 10 years, that means after 10 years, whatever you pay today, after 10 years, Peloton comes for free. So do you believe that Peloton may be around after 10 years? I think it will. Okay. So that's the kind of thing you don't need to kind of overcomplicate and this and that. Obviously, you can peel that back and say, hey, listen, yes, perhaps the business will be around, but the subscriber base will be substantially smaller. And that is a valid bear thesis. But it's important to just kind of not over dramatize what is the amount of stock-based compensation. Like I found this particularly during the COVID period, a lot of developers would be like reaching out to me and kind of getting caught up with like really detailed things about business and say, oh, but the business doesn't use this Python thing and it's never going to be adopted by like blah blah blah. People believe that because they understand like an idiosyncratic aspect of what the business does, it gives them a good feel for what the business is worth. Completely false. It's completely false. Okay. Just before I move on, Chris, did I answer your question about stock-based compensation?
Yes, you did. And I lost out on Palantir for this exact reason. I sold it at I think like $18 or something. Mm-hmm. Bought it at 12 and sold at 18 and lost, I guess, big time because there was a lot of articles around that time which said that the stock-based compensation is very, very high, and it scared me. So I ended up selling it.
Can I just say one thing? What you've sold is never a problem. You are never, ever, ever going to get out of the top. Okay? Never. It's much better to sell into the strength. Think about what I said at the start. That money that you've worked hard for and you've invested, it's your money. You need to like really be protective of it. Like you need to really think about that. And like I get quite passionate about investing. I'm obsessed. I'm completely obsessed with investing. But the first thing that you need to think about is that preservation of capital. And I mean, it's so important. For me, personally, I find that it helps having someone in your life that you can talk and say, listen, at the end of 2024, I need to get to these numbers here and have a plan to get something that is realistic as a percentage of the portfolio and work towards that and have that accountability and have that discussion ready in your mind. And I find that that's actually a lot more helpful than saying, oh, I bought Palantir at 12 and it sold at 18 and now it's at 43. Like, that's not helpful. And, you know, it's much better for you to sell Palantir at 18, even hypothetically putting it in cash, rather than trying to kind of over worry yourself, because there's always tomorrow in the market. There's always tomorrow. There's always a new story. There's always something more interesting happening tomorrow. So think about that. And, you know, for me, I speak to my wife, and maybe you can speak to somebody like you care about, or even like, you know, go for a walk with a dog and just kind of explain to them what you're trying to do, you know, and because having accountability is really helpful to kind of get you on the straight and narrow. Yeah, it's investing is difficult, you know, and you shouldn't, a person, in my opinion, should never look back in the market and say, oh, this is what should have done, because that's not helpful, you know. The only time when it makes sense to look back and say, okay, this is what I should have done, is the period that you made a loss. That's the only time, because that's the cost. Let's say hypothetically, you made an investment, you put down $1,000 and it went down 50%, you lost $500. So those $500 was the cost that you had to learn that mistake. So that's the way that I think is actually more helpful. That kind of helpful. Just one second. Sorry, Luke, just one second. Did I help you, Chris?
Yeah, there's one, sorry for, I think somebody was trying to speak.
Yeah.
So there's one aspect that I keep thinking about, which is I try to use data to decide between whether I'm in a fearful state or whether I'm in a greedy state or whether I'm in an indifferent state.
Yeah.
So what I want to do is and this is me trying to get better as a person, is I don't want to be in any of these three states.
Okay.
I just want to be logical and just follow the market and do what's right at that moment. So I try to take a more analytical approach. And so when this whole SBC conversation came around, it was, I couldn't differentiate between whether it was fear mongering or whether it was actually data. So I wasn't able to understand the difference. And that's where I was trying to decide, okay, what should be my decision? And I don't want to give in to fear, greed, or indifference.
So a couple of things. Number one, like it's okay to not understand something and say, you know what, I don't feel very comfortable. That's absolutely fine. Because the problem is, hypothetically, just for our discussion, you invest in Palantir today, okay? And tomorrow, or not tomorrow, but next week, it's down to 35. You're like, oh my God, like you panic because you want 100% confident and comfortable to get in a position to start with. You know what I mean? So it didn't work out for a really long time. I invested in Uranium Energy Corp 2 years ago at $7. I saw it go down to about $1. I can't remember now. I was like, but I believed, I had a lot of conviction in that. And, it doesn't mean I couldn't be wrong, but it was a business that had no debt. So, yeah, it was painful. And they might have been a big shareholder dilution where they dilute, let's say, 30 or 40% of my holding, but they had no debt. So it was impossible for it to go bankrupt if there's no debt. But I was convinced, okay? The problem is when you're not really 100% sure and it comes down on you and you're like, and just that's the first thing. And the second thing is there's a study, and I don't remember the numbers here, but just write with me. One of Peter Lynch's 2 books, he talks about if the investor had invested in S&P once a year for a period of like 10 years. And in a second study, if they had bought only at the dips of the S&P over a period of 10 years, and per year, the annualized outperformance was like 2% or something like that. So if you just picked, it's not that big a difference. So it's actually much better the time in the market rather than timing the market. So about your 3 states, it's better to approach with the thought of, okay, I'm putting this much money aside and I'm not going to touch it for, let's say, a year or so. I think that's more helpful. Historically, in my experience, the worst of the bear markets have lasted on average 18 months. Okay, a slightly longer one was the depression of 1930, which was 2.5, and the one of 2008, which was just about 2 years. But generally speaking, 18 months. 18 months is difficult. Trust me. Like Uranium Energy Corp, I've been recommending this damn HIM stock for like 2 years, man, and that's been brutal. So don't believe that just because it sounds like 18 months is quick. 18 months is anything but quick. It's really brutal when everything is blowing up in your face. So I don't take that lightly. But having this assessment of yourself and say, okay, I'm going to deploy this capital, one thing is theory, another thing is practice. It's easy to say that, and then in reality, it's really, really difficult. But I feel that's helpful to me when I said, okay, I want to accumulate so much money until this period of time, and I find that's helpful for me. Giving the businesses time to do their thing, yeah. And that's why I like my kind of 12-month holding period. Yeah. Okay. Let me just go on to Luke, if you don't mind. Afterwards, if you want to hit me a question, if you want.
Perfect,
Luke, sorry to interrupt you, Luke. Go on, please. Hi, Luke, do you want to ask your question?
Yeah, I was just gonna ask, what's a reasonable SBC? You know, how do we know
So
it's
some people believe, so that was the question we were discussing before. Some people believe that, I don't want to give the hard number. I don't want to give a hard number because, you know, I've seen businesses that have like excessive stock-based compensation, and then 3 years later, it's like, oh my god! Like, okay, I'll give you an example. Samsara has a very high amount of stock-based compensation, and this. If you overanalyze that, you'd be like, oh, I'm not going to invest in Samsara, and you're missing like the opportunity. So when the business is young and they're growing quite fast, there's a lot that is not hard tangible stuff. When the business is very mature, like Microsoft, then they have, let's say, a data center, and that's not stock-based compensation because they've already built the platform out. But at the start, when you're building out the platform, the stock-based compensation is going to be your biggest expenditure. Okay.
But so how do you determine that Palantir has excessive?
You can see, man. Like, I don't know. It's like in the case of Palantir, you can see like it's just the guys are making like several billion. I know that the market cap of Palantir is really high, but actually the revenues are not that big. So proportionately, it doesn't make a lot of sense. But that doesn't stop that from having been a really good investment. I don't want to get caught up in the specific number. I do have a general number in my mind, but I don't want to be too caught up in that because I gave the example that would have kept me out of Samsara. So I don't want to be like too hard and fast about that. I'm sorry. I'm not that I'm being shy. I'm just kind of, there's some nuance. Yeah. I'm sorry. Yeah. Let me just hold on to this question 1 second. So I believe that as we're going into earnings season, it's helpful to have enough capital, 5 or 10%, so that when there's a new idea show up, you can be ready to go. Because the worst thing that you want is a really compelling idea to happen. You can even leave 2.5% on the side, but to have a really compelling idea, and then you have no cash to execute on that really good idea. That's what I've been trying to do. I sold off Powell Industries, and I'm trying to kind of alleviate a little bit of the capital so that I risked the networks last week so that I can, execute and when something shows up. So I think having a small amount of capital on the side, don't need to be like a lot, but just a little bit so that, if something happens, you can kind of, it's like oxygen. I like to call it like oxygen. Yeah? No one cares about cash on the side. It's like breathing, when you kind of walk, think about it, but when you need it, you really need it. Okay. I wanted to just touch on very quickly about the fact that in investing, it's important, in my opinion, not to overreact to the share price, instead to react to the earnings. So this particularly is about Ouster that I was talking to you, Luke, about it before. Ouster, if in hindsight, looking back, it has not been a successful investment, I felt that it had more potential, and the share price got absolutely decimated. Now it's coming back, interest rates are coming down, and so every stock is going up. So it's not particularly to Ouster coming up, it's just that every stock is coming up now. So it's not that Ouster is particularly magnificent. But I want to react on the back of earnings results to make an active decision rather than, the share price is this, therefore I have to do Y. Because too many people are like, okay, the share price is down. Do I buy? Do I hold? Do I sell? And they have this kind of like uncertainty. And it's better to just say, okay, you know what? I don't actually know if it's a good decision to buy, to hold, or to sell right now. It's actually much better for you to just sit on your hands, when the earnings come out, say, okay, actually, the business is actually growing at 33 or 40, 34% at the growth rate. Okay, the business, they've managed to kind of turn this ship around. They're taking back market share. That's cool. I'm happy to support this business for another 12 months, because that's really what it takes, in my opinion, is not that they had a good earnings result this week, therefore I'm going to hold it for another 2 weeks. I believe, and different people have different investment styles. Like you, Luke, I know that you kind of you're more nimble. People have different styles. But in my opinion, it's that thing about conviction that I was saying before. It's much better to say, okay, I want to buy this, and I'm willing to sit on my hands for 12 months. Because in the market, a lot of people like to believe that they know something, or they can see something that nobody else sees. And if I get in now, I can get out quickly in 2 weeks' time. And then, in my opinion, the market's too smart for that. And there's no kind of free lunch. It's much better, in my opinion, to take the foot off the accelerator slightly, be a bit calmer about it, and get the destination rather than thinking that anyone is smarter than anyone else. It particularly seems to me that in this game, a lot of alpha males believe that they know more and they're the smartest person in the room. And it's much better, in my opinion, to say, okay, I'm going to just slow this down a little bit. I'm not the smartest guy in the room, and not pretend to be. I think that's better. That's just my opinion anyway. Okay. Is there any other questions that anyone wanted to ask?
Hey, Michael, I have another question if nobody has any.
Yeah.
Yeah, my question is, I am getting I'm a subscribed member, but I also look around the Seeking Alpha, try to, to follow a couple other analysts, reading their article.
Yeah.
And I have a daytime job, and I'm not always, going day to day.
Yeah.
I happen to see your article about Oklo, which you published on October 17th.
Yeah.
That is not a trade alert, okay? That's not a trade alert for our source, but you also published article over there.
Yeah.
But I noticed that this morning, while I was reading that, I noticed this morning, and right before this meeting starts, like by the time that you recommend that stock, to general Seeking Alpha people, it was $16 something. And this morning, it has some volatility and it dropped down to 19, but still, there was a profit over there. And with this, again, maybe it's a fancy word, but with this gold rush, and also, the Amazon decided to invest in $500 million to the nuclear reactor.
Yeah.
So, how much kind of importance should we emphasize your article that you publish into general Seeking Alpha? Because yes, you're saying that don't look at the past, but it was within 6 days of time frame. I wish I read it earlier. What's your it's not a trade alert again, but you're giving the spatial information to us on our spatial channels.
Yeah, two things. Number one, I want the subscribers that pay. Not everybody, is like Luke, that is able to navigate like tons of different analysts and this and that. Some people have a daytime job, and I want it to be very simple. A person goes with the trade alert and sells when I do the trade alert. And if you have done that with the equal-weighted portfolio, you're up 40% so far this year. That's a very good return. Minimal work, like literally, like once a month, buy the stock that I recommend and sell the stock that I recommend. No work at all, just following me blindly. Similarly, I believe that having 2 positions in the portfolio, I've got 20 stocks, 19, 18 because I've got 2 positions left, but generally I run with 20 stocks in the portfolio. 2 of these are uranium related businesses. I don't want too much concentration in that. That's what I was telling you before. I've seen a few cycles in the market where certain things seem to work out really well. Sometimes, like for example, a few years ago, work from home trades were like working really well. You didn't need to overthink it, worked really, really well. The back end of 2021, software as a service was working really well. So there are times where these macro aspects work really, really well, but you don't know. Okay, here's a really good example. 3 or 4 weeks ago, anything that was China related was to the moon. You didn't like everything. It was just like China, moon, China, moon. And I didn't want to have people too concentrated on an idea. So I own, not because of that, but I've owned for a while Giga Cloud Technology. And that business has some China exposure, but I don't want everything to be like, okay, now there's a gold rush here. Let's run here. No, now let's run here. Because I don't want it to be like that. It doesn't suit my temperament. My typical holding period is about 12 months. And I know why Oklo is doing really well because, it has no revenue. So there's no accountability here. It has a ticker, which is, interesting. And secondly, Sam Altman owns about 2% of the company. Therefore, off to the moon we go. But I don't want it to be like that. I don't want to run that type of subscription. I've got quite a lot of concentration already in this uranium idea. I don't want all my eggs in one basket. I prefer to drive a tiny bit slower and get where I want to be rather than trying to be a hero.
Okay, thank you.
Look, in the market, there's many different ways to kind of do stuff. And there's a lot of fear of missing out. And people believe that this is easy. This isn't easy. And there's no free lunch. And I promise you that this kind of running around and trying to be like the smartest guy, it doesn't work out. It's much better to just kind of slow it down slightly and try to get, outperformance. Yeah, I know it's not the sexy idea. Outperformance is not that attractive for some people, particularly when, something like Oklo's up like substantially in a few weeks. But I feel that over time is much more rewarding. Okay. Thank you very much. I really appreciate coming on the call. Thank you. Haji? Is that right? No? Haji? Haji. Cool.
Yes, Haji.
Haji. Cool. Thanks very much. George, just want to say hi because you're always like devout here. Thank you so much for your help. And Luke and Chris, thank you very much. Yeah, okay. Really appreciate it. So next week we'll start off earnings season. Like we got Meta. I'm hoping to get rid of Meta before the earnings come out. I really want to try and get rid of the stock. I just don't want the risk. I want to alleviate the portfolio. Yeah, just free up some capital. Yeah, so next week's going to be the start of the brutality. Okay, thank you very much, everyone. I'll see you soon. Thank you. Bye.
Thanks a lot.
Thank you, Michael.